Hello and welcome back to another edition of the podcast. My name again is Brian Courtney. With me today is my guest, Steve Raffuel from Raffuel Surety Group. Steve is a recent acquisition of Patriot Growth Insurance Services. I was excited that he is now on board with the Patriot Growth Insurance Services team, as a lot of our clients are starting to have greater surety needs, and having an expert like Steve on the team is vitally important to our long-term growth. I'm going to give a minute for Steve to tell a little bit about himself, but for our purposes and who we are and what we do, we are a full-service insurance brokerage and risk management advisory firm, doing everything from commercial property casualty insurance to employee benefit services to individual property casualty and individual life and disability needs. And now we also have a national surety practice through Steve. So with that being said, I'm going to kick it over to Steve to tell a little bit about himself, his background, and we're going to get into a discussion about surety. So hopefully you enjoy our conversation. Steve?
Thank you, Brian. Thank you.
You're welcome.
So my move to the Patriot Group, Patriot Growth Insurance Services, occurred over the past 4 months approximately, and seemed to be a natural fit for us with your position in the marketplace, both in construction, where a lot of the surety bonds emanate, and in commercial insurances, but with a yearning to grow its surety practice, but without necessarily having the talent or the skill set in-house. It became a natural fit for us. I had been in the surety business since 2 weeks out of college. And that was a while ago. So
2 weeks ago?
Yeah, 2 weeks ago. It was just I graduated in May.
Yeah.
If they ever legislated out of business, I'm done.
Yeah.
So I have done surety work both as an underwriter at the local level. Spent several years in the home office of one of the major insurance companies in Hartford.
Yep.
A while back, and have been on the brokerage side for the better part of the last 25, 30 years.
Great.
Started my own firm approximately 13 years ago.
Okay.
And started that with the intent to, as our motto said, bring value to the customer, not just in terms of solving the immediate need of procuring a surety bond, but bringing value to their long-range plan. What is their business plan? How does it fit? How can we help? How can we keep them out of trouble? Those are some of the things that a professional surety broker does.
Right. That's great. So I do want to get into the discussion because more often than not, the insurance broker kind of sits in the seat of the surety broker. And the two terms tend to get confused out there in the marketplace. And I wanted to have a brief overview of the differences between surety and insurance. Can you kind of describe what those things are?
Yeah. Actually, I still try to explain it to my family after many years. They still don't understand. But the only common denominator there, Brian, is that they're both written by insurance companies.
Right.
Frankly. That's sort of where it ends. In insurance, you pay a premium for a policy that pays if something happens.
Right.
Fire, car accident, things of that nature. In surety, you pay a premium for a policy that pays if something doesn't happen. If the underlying obligation that is guaranteed by the surety isn't fulfilled by the principal, then the surety would step in. So they're sort of completely opposite. It's much more like banking or co-signing a loan than it is insurance.
Great. And what are the different types of roles within surety bonds? There's different roles. You mentioned the principal, the obligee, and the surety. Mm-hmm. And how do they play with each other in those different roles?
Sure, and that's another critical difference between insurance and surety. Insurance is a two-party agreement, the policyholder and the insurance company. Surety is a three-party agreement, the principal, the surety, and the obligee. And where that changes in the picture of things is that the person buying the insurance policy is the beneficiary if it's an insurance policy. The person that buys the bond is not the beneficiary of the bond. So the surety is the insurance company, they're the guarantor. In this case, the principal, the party whose performance is being guaranteed, purchases the bond for the benefit of the obligee.
Okay, great. So what are the different types of surety bonds that you work in and the different types of maybe industries that use surety bonds?
There are hundreds of different kinds of surety bonds, but if you look at the market overall, 70% of the revenue of the income for surety bonds comes from the construction sector. The other 30% is what we call commercial, and that could be anything, any business from hauling and transportation to import and export, where you have to pay duties and fees. Some of those are, you've probably heard of court and probate bonds, if there's a will or a minor, those kind of things. Those are the other 30%, but there's hundreds of kinds of those.
Crime bonds.
Fidelity bonds are sort of fit in that, employee dishonesty sort of fit in that mode a little bit different, because there's sort of an implied underlying contract, and an implied underlying contract is you're not going to steal from somebody.
Right. Yeah, right. So let's talk about construction and surety bonds and just how important they are in the overall process of construction projects. If you can kind of give an overview of that.
Sure. Construction is an industry that is, for the most part, mandated to provide surety bonds. Any public works contract, local, state, federal, there are statutory requirements at all levels. They require the placement of performance and payment bonds equal to typically 100% of the contract value to guarantee the successful completion of the project according to plans and specifications in the time allotted, and the guarantee with the payment bond that all the bills will be paid and the project will be lien free. So construction drives a lot of the revenue because you have to get it. You have a choice.
Yeah, right. So within construction and what's the key differentiators of working with you versus working with somebody that maybe does surety on the side, and obviously having worked in the field for as long as you have and just purely specialized in the surety space, I have to imagine there's some things that we're bringing to the table now that somebody that's doing surety as a side hustle, quote unquote, might not be able to deliver on, right? And where that can have some impact on the client.
Sure. Sure, and that can run the gamut. And it depends on the stage of the client. Not every client that you work with is in optimum condition at the time you're working with them. And anybody who's in construction surely knows that it is far from a Wall Street graph in terms of operating revenue and results and things of that nature. Every contractor has bad jobs, every contractor has problems. So you need to know how to manage through that, both in maintaining the relationship with the surety, but helping the contractor look forward to fixing those issues. We've had discussions with clients about management reviews, for example. I had a client several years ago that just kept kind of dumping money personally into the business. They'd lose money, he'd put money in, they'd lose money, he'd put money in. Finally, it's, time out. There's something wrong here. It's you can cure the surety problem by putting money in, but it's just apparently falling out at the bottom, so maybe you need to really kind of find out what the issue is there first before you move forward with it. And so understanding the animal you're dealing with, understanding the construction segment, understanding the risk associated, where they can be, is very important, both in helping your client and in helping them secure greater surety by educating the underwriters of where the risks are, and sometimes where the risks are, and how they're going to manage and mitigate those losses.
Yeah. And we're considered construction risk insurance specialists, and we pride ourselves in being technicians when it comes to coverage is concerned. Do you see that also operating in the surety world? Is that contract and making sure that that contract is as tight as it possibly can be?
We do spend time, not so much in public works because you don't have a lot of leverage,
right?
But in private sector work, yes, we're very often, we'll always ask our clients to show us the contract before they sign it. They don't always do that, but we like to look at those because we want to look at things like the payment provisions. We want to look at the retainage provisions, the damages provisions, the things that can come back and bite them. Right. And we like to do that because doing it early on is very effective, especially in a negotiation on a private sector project, to get some leverage for the client.
Right. And I have to imagine now that you're within the Patriot Growth Insurance family, being on the broker side versus being as a surety broker, but also being an integrated part of the team, I think lends itself some advantages for the surety work that you're doing, correct?
It does, it absolutely does.
And what are some of those advantages?
So the insight that you would have, first of all, there's a relationship insight.
Right.
You and the other producers here at Patriot have relationships. They have there's a level of trust associated there already, which allows me a window into the operations well in advance of any meeting, sit down I might have with any of the clients about surety.
Sure.
What are they good at? What are they not good at? You know, sometimes the insurance claims tell a story about other things associated with the operations, and that's important for me to know.
That's an interesting thing that you just said, that the insurance claims actually give you a window or a picture into something else that could impact surety. Can you expand on that a little bit?
Yeah. The link between workers' comp claims, for example, and workflow. You can't operate projects successfully, you can't operate them smoothly from beginning to end if you're incurring a lot of claims along the way, especially workers' comp claims, because there's the work stops, maybe OSHA comes out, there's a herky-jerky nature then to the completion of the project, but it means they're not going to make the money you thought you were hoping you were going to make. And it may speak to things like field supervision.
Right.
It may speak to other quality control issues which could turn into larger losses, which could impact the balance sheet, which could impact the surety capacity.
Sure. And like insurance companies do, and you know, insurance companies are doing surety, as you mentioned, are they looking at those things as well? From a risk management perspective, like so safety and loss control, is that also part of the surety process?
Some of them do,
Okay.
not all of them. Some of them do. Some of them want to know what the comp mod is. You know, some of them want to know who the insurance carriers are. You know, they'll ask for insurance certificates because they ultimately, if the contractor folds for whatever reason,
Right.
theoretically, if they do a lot of bonded work, the bonding company's holding the bag. Well, one of the reasons they fold is they've got inferior insurance and large gaps in their insurance, or they've got a weak insurance company, then which leads to uncovered losses, et cetera, et cetera, et cetera. It could be problematic. But they don't ask the question as much as I think they should.
But maybe they're not asking the questions, but if a broker is helping a client in that capacity, making sure that they're optimizing the coverage that they have available to them, right? They're making sure that the coverage is in place to provide the proper protection. They're doing everything from a loss control perspective to make sure that claims are not happening. I would have to imagine that puts us in a greater negotiating position with the surety companies in placing the surety bond. Is that accurate?
Yes, I think it's fair to say, because if you're doing those things, if we're doing our job on that side,
Right.
that's going to translate into a picture on the contractor side of, you know, you're only as good as the company you keep sometimes.
Right.
And so the company you keep keeps you out of trouble, insures, tries to maximize your profitability or minimize your losses.
Yeah.
So that absolutely translates. And ultimately, I have people ask me this question, contractors have asked me this question for a long time. So why are sureties so focused on the balance sheet? Why is it the balance sheet? Why is it always the balance sheet?
Right.
Well, the balance sheet is kind of like, it's kind of like going to the doctor and getting a physical.
Yeah.
Right. Depending on what pops up on the balance sheet, it's going to tell you, ooh, you may have a problem here.
Right.
And now you got to go find that problem and figure out where it is. But everything that they do eventually makes it to the balance sheet, one way or the other.
Excellent. I would love to hear a success story where you came in and quote unquote saved the day from a really bad situation and improved not only the surety placement long term, but help the company become a better version of themselves,
Sure.
You know, from a risk perspective.
Sure. So I'll go back. There's a couple of things that kind of popped into my head, but one of those will go back to the management report issue that I mentioned before. It's an account that I had acquired, and in the short period of time that I had them, I think a lot of other brokers had surrendered, a lot of other, because they just couldn't manage some of the internal dynamics,
Yeah.
sort of family dynamics, which can happen a lot in construction. Construction is very often a closely held family sort of scenario, and the transition from generation to generation doesn't always go smooth. And so I was able to manage that because I could relate up and down in sort of in age. But they had gone through a number of sureties over a period of years. It happened to coincide with the 2008, 2009 economic sort of debacle, so there were some reasons to it, but they were still kind of bleeding. And at that time is when I said to the principal stockholder who wanted to put more money in the company to continue to get a surety credit, it's not in your best interest.
Right.
It's in my best interest for you to put money in the company, continue getting bonds, but it's not in your best interest. So maybe it's better if you do this, and we saw he eventually found someone to do this, and they did a great job. Some aha moments actually for me, and I've been in this business for a long time on it. And we used that tool then to take these pretty crappy operating results and dealing with the management report that said, here's the problems, and here's the game plan on how to fix them, and go to a surety and restore surety credit without them having to put another $1 million back there.
Right. Interesting. So I do want to segue last to kind of where surety started in your career, where it is today, and where do you see it evolving in the future? And specifically, I want to talk about how, whether you're a contractor or any other client or prospective client of Safegard Group, what would be some of the things that they should look for in us or expect from us with a now established surety practice?
Yeah, so surety is an old product. There's actually, I understand, I'm not this old, there was some reference to surety in one of the ancient religious texts.
Right.
Okay,
Right.
I'm told.
Right.
I'm told.
Yeah.
So surety has been around for a long time, but at that point they were talking about personal surety, that
Sure.
I would be surety for you.
Right.
And that goes on today, right? If you've got a kid, you want a car loan, you co-sign a car loan.
That's right.
You're being surety. So the surety business has been around. It's a very, very stable, not very innovative, in part because what you're asked to deliver is required by statute, so you can only wiggle a little bit in there. It is sort of what it is. The business has been historically very profitable. It continues to be very profitable for the insurance companies. It has led to a bunch more competition of late, but it doesn't seem to have really damaged the results in a meaningful way in quite some time.
Does the economic climate have any level of impact on surety, whether the economy is doing very well or whether the economy is doing poorly or stabilizing? Does that have any impact on surety?
Sure. But it's a lag indicator.
Okay.
I should also say, just going back for a second to what I mentioned before about the insurance companies, surety companies enjoying good operating results. Many years ago, when I first started in the business, the theory was that surety underwrote to a 0 loss ratio.
Right.
That was how you were taught to underwrite. Not likely, but that was sort of the theory. And at that time, accruing what I think were called IBNR, right, incurred but not reported losses, was not part of the surety animal. That phenomena started probably 30 or so years ago. And so in the many years where they have good operating results, and this is typical for surety, you have really good operating results, then you have a disaster, and then you have another 10 years of good operating results and a disaster. But in those 10 years, they have set aside funds to kind of level out those results, and that's one of the reasons why you see continually good operating results. What was the other question?
I guess where we talk about the economic climate, obviously you said earlier that construction is a big part of surety, and within construction there's the peaks and valleys based on the economy. So I'd have to imagine that if in good times when construction is going strong, which we all love for our clients when construction is going strong, but in and downtimes as well, does that have any impact on surety?
Yeah.
You know, does it increase the competition when the demand is low? And when the demand is high, you know, and people need more surety, like it's, you know, is there enough supply to offset, you know, the potential risk that they're putting out there?
Yeah, all those things enter in for different reasons. So in a down economy,
Mm-hmm.
you would have less spending in general, whether that's because of the fear of where the economy is headed. So on the private sector, there's less spending. There's also less tax revenue at the governmental level. So there's less money to fund public improvements. Those things kind of go hand in hand. The recent cycle of inflation certainly has impacted the construction community and the spenders, because now they had to cough up more money than they wanted to. Some of our clients, some of my clients, some of everybody's clients got kind of caught with contracts that didn't speak to this potential, because inflation hasn't been an issue in 30 years.
Sure.
So who's now paying for that delta? And that impacted a lot of balance sheets. I would guess that there's a lot of larger trade contractors, mechanical, electrical, plumbing, that have taken a bit of a beating over the last few years because they were stuck with those kind of contracts. And one of the things that it also does is, we've seen this historically, and this is where having experience and knowledge really comes into play, is when the private sector activity dips. Let me go back for a second. Contractors tend to be the first ones into a recession and the last ones out.
Right.
Because they hear there's no more work coming out, and they just start driving. Well, we got to get this next job, so they drive this, and then somebody else sees that, so they just keep driving the prices.
Right.
And then when you're coming out of a recession, they don't believe you, so they tend to hang in there longer than they normally do. But what we also see is typically private sector contractors now turning to public sector work to bid because that's what's available. Those are two very, very different animals. The differences really revolve around motivation, end use, all those kind of things, but the mindset is totally different. You're working for a developer, you're building a condo project, they're going to cooperate with you to get that project done, because as soon as you're done, they can sell units.
Right.
You generate revenue. Public sector, they really don't give a crap. So, here's the bid, here's the specs.
Good luck.
Figure it out yourself.
Right.
And private sector contractors aren't used to that mentality. So when I see private sector contractors wanting to do that, it's always just okay, take your time, dip your toe in, get a feel for it. You might not like it. So that's where experience comes in.
That's great. So I think this was a great conversation. I've certainly learned a lot more about surety and how it works in conjunction with the insurance brokerage services that we provide. I think the takeaway from all of this is, do you want to be dealing with a generalist, or do you want to be dealing with an expert like somebody like Steve? I'm excited to have him as part of our team going forward, not only here, working in the greater Northeast region. Your offices are in
Princeton and here in Media, Pennsylvania, with you with the Safegard group.
Yep. So, so if anybody has any questions about what we can do for you, both from the insurance brokerage side as well as the surety side, our contact information will be after this presentation. Steve, thanks so much for your time, your level of expertise. Excited to have you as part of the team, and looking forward to working with you going forward.
Thank you. Same here.
Thank you. Take care. Take care, everyone.